He is Royce Mendes, Managing Director and Head of Macro Strategy at Desjardins, and he joins us here in studio. Royce, it's nice to see you.
My pleasure.
I guess since we're going to be talking about risks of the financial system over the course of the day here, that chart seems like a risk. How concerned are you right now?
Well, we are concerned, but we're concerned not necessarily about the near term. It's about 2025 and 2026. That's when the people who took out variable rate mortgages at extremely low rates in 2020 and 2021 are up for renewal. The reason is that these variable rate mortgages, they tend to have fixed payments. A lot of the financial institutions today are not forcing people to make the full interest payment. They're keeping it to the fixed payment. So these people with these variable rate products are not even covering their full interest. What's happening with that interest is it's building up in principal. So it's really just kicking the can down the road. And at the time for renewal, that's when the payment shock is going to hit.
So a lot of people have said, well, if you've got a fixed rate mortgage, and then you have to renew, you're going to get some sticker shock when that comes around. But you're saying if you're in the variable market and you think you're already dealing with that sticker shock, there could be more come time for another renewal.
Absolutely. There's no doubt that people are having sticker shock, both fixed rate mortgage holders and variable rate mortgage holders today. But it's really when we get to a few years down the road that these people who haven't been paying principal or have actually been seeing their loans increase over this time frame get the real sticker shock. We see payments potentially needing to increase 40% at renewal for some of these variable rate mortgage holders. If people want to try to keep their payment the same, of course, they can try some mitigation strategies. One would be making a lump sum payment, but the lump sums are huge too, 30% of the total loan size. You want to try to extend amortization? Well, amortizations in some cases have to go up to almost 40 years. I don't think that's going to be allowed in terms of how the regulator sees things.
Now, here's the challenge. A lot of people went into the variable rate market the same way that banks were putting money in long-term treasuries in the United States because the messaging from central banks was, we're not ready to raise rates. So the aggressive rate rises that we have seen play directly into this story. But I already mentioned it's been a complicated week because the Bank of Canada had been on pause, and maybe some people were wondering, well, maybe those higher rates might start to pull down a little bit by the end of the year. But then you've got these inflation numbers, which are reminding us the challenges in fighting prices right now. How do you balance that?
You know, I think that it was one number, but it was one ugly number. And it really showed beneath the surface that inflationary pressures are not coming down as fast as the Bank of Canada would like. Now, in terms of the outlook for the June 7th meeting, the U.S. debt ceiling stuff is still clouding the outlook. And if things get as bad as I think they could get, then the bank might want to skip that meeting and, think about the next meeting or a few meetings down the road in terms of when to, move rates if they need to be moved. That being said, though, there has not been as much progress on the inflation fight as we or the Bank of Canada expected. And those underlying inflationary measures, the 3-month annualized core trim, core median, core services ex-shelter, all of them show that there is a stickiness of inflation around 4%. The bank thought they could get to about 2.5%, in not that much time. It doesn't look like they're going to get there very quickly.
So you're not currently expecting the bank to raise rates at that early June meeting. There is there are a number of folks on Bay Street who are now thinking maybe we'll see that. But that's not to say that you think there isn't the possibility that they would have to raise rates in the future.
Yeah, I think it's a very close call. I think it's almost a coin flip for the June 7th meeting at this point. We will hear, as you mentioned, more information at the Financial System Review press conference. Obviously, Macklem always tries to avoid commenting on monetary policy. You guys in the media try to get it out of him, and hopefully someone will do a good job to try to get some information on the outlook for monetary policy. We'll see what he says. That could tilt the odds in one way or another. But at this point, there's so much of a cloud hanging over the American economy, which translates into a cloud hanging over the Canadian economy from this U.S. debt ceiling stuff and still from some of the reverberations from the banking stresses in the U.S. as well that could keep them from hiking rates in the near term. That could change, though, very quickly.
A lot of bruised apples on this apple tree right now. I just want to come back to housing because your Bay Street colleague David Rosenberg was just highlighting, and we've even looked at the data, that home prices are finding their groove again in this country. And I don't know if that's because the Bank of Canada itself went into pause mode. But given what you're talking about with some of the worries on the mortgage debt in this country longer term, what do you make of the fact that people are willing to pay up in big ways for homes again?
So in the report we published, we said specifically that we don't think that any of the work we've done means any catastrophic outcomes for the housing market. The housing market has this underlying bid from population growth. That's one of the reasons we've seen so much employment growth. That is pushing up house prices. There are so many people being introduced into this economy, and there's still not enough supply. So house prices have this underlying floor. And one of the things we talked about also is that this is not a near-term phenomenon that we're talking. We're really worried about the outlook for a few years down the road. In the near term, the housing market probably does have scope to begin growing again and expanding, with prices finding a floor and probably starting to rise a little bit in the near term.
We're almost out of time, but it sounds like you're saying beyond whether we're in a recession or headed towards a recession, beyond that, just the fact that people have had to pay more towards interest in their mortgage is a complicated story for the economy.
You know what? The pandemic is going to have a long shadow on the Canadian economy. When we look out to 2025, there are challenges out there, the energy transition, trying to reshore manufacturing activity. Canada has a major problem with productivity. But the overhang from this mortgage debt that was taken out in 2020 and 2021, I think is going to cause even more challenges for the Canadian economy out a few years. And the Bank of Canada, the federal government, the provincial government, municipal government will all have to take this into account when formulating policy.
Well, we'll see.